What is accounting? Account means explain. Accounting is thus the process of providing explanations. In order to provide explanations, the accounting process records actions or events. These are called as transactions. Thus, accounting is the process of providing information about the transactions of a business. It is for this reason that accounting is called the language of business.
And when I took that introductory accounting class, my first accounting course, I discovered that accounting was the language of business. And it's a language of business because its sole purpose is to communicate information to business decision makers.
Accounting information is useful to business managers, owners, creditors, governmental units, financial analysts, employees, labor unions, and so forth. There's a broad group of interested parties in accounting information.
The internal users are used for planning, organizing, and running the business. So finance, is there enough cash to actually pay the bills? Then there's marketing. What's the correct price to sell products for the maximum profit? Then there's human resources, and they have to ask how many employees can we afford to hire. And last, there's production. They have to ask which production line is the most profitable. External users, they are used for decisions of ownership, credit, lending, assets, compliance, and performance. The first external user is creditors. They want to ask if the company is able to pay the debts. The second external user is investors. They have to ask, is the company earning enough to give return on investment? Then there is the government. They always have to look at the taxes and other auditing to make sure that there's no scams going on or illegal activity. And lastly is the customers. They want to make sure if they can stay in business long enough so that they can purchase items and so it won't just be some sort of scam as well.
The balance sheet oftentimes is referred to as a photograph or a snapshot. That is, you add up the amount of money. You'll notice from this PowerPoint slide I have here, on December 31st of 2009 and 2010, this company had a certain amount of money, which is in millions of dollars, in their account. And the way the balance sheet works is it looks at your assets and your liabilities and owner's equity. Owner's equity being whatever asset, you take the assets and you subtract out what you owe people, the liabilities, and that's what belongs to the owners.
The balance sheet is divided in two main sections: the asset section and the liability and equity section. More in detail, the assets section is comprised of current assets and non-current assets. Main current assets are cash, accounts receivable, inventories, prepaid expenses. The current assets are called such because they are usually on the balance sheet for 1 year or less. The current assets are usually listed on the balance sheet according to their degree of liquidity. Therefore, cash is the most liquid, while prepaid expenses the least liquid. Cash is available at any time. Accounts receivable, sum of money to be received from customers. Inventory, a list of goods to be sold. Prepaid expenses, some paid in advance. The non-current assets are also called long-term assets. Indeed, those are assets that will stay on the balance sheet for years, such as plants, equipment, furniture, and so on. On the other side of the balance sheet, we have the liabilities and equity. Liabilities are comprised of current liability and non-current liability. Current liabilities stay on the balance sheet for less than a year. Non-current for more than a year. Let's see the main current liabilities. Accounts payable, sum of money not yet paid to suppliers, that will be washed away once paid. Accrued expenses, sum of money to be paid in the future, such as payrolls or tax. The main non-current liability is long-term debt, such as loans contracted with the bank.
only thing that matters is how much a business gets in cash and how much it pays in cash. If it has $100 in sales, but only $80 is collected in cash this year, the cash flow statement will only record $80 in cash inflow. This year's cash flow statement also includes cash collected for previous year's sales or even future year's sales, as long as it's collected this year. How about cash outflow? If the business has $60 in costs and expenses, but only pays $50 in cash this year, then the cash flow statement will only record the $50 cash outflow. This year's cash flow statement also includes cash paid for previous years or even future years' costs and expenses, as long as it's paid this year. And, in addition to costs and expenses, this year's cash flow statement also includes cash which is earned or paid this year for a business's property, equipment, and taxes.